Okay, so I will be presenting my final project for Fin 226. The topic I've chosen is impact of US interest rates on UAE and Kingdom of Saudi Arabia. So before I start, there are a couple of key terms that you need to know. So one, what is an interest rate? Interest rate is the price you pay when you borrow money, shown as a percentage of a loan. Now, what are interbank rates? Interbank rates are the rates at which banks lend to each other. So in this case study, I've used the US interbank rates, and I've also used the interbank rates for UAE and Saudi Arabia. It moves similarly to the interest rate, and the reason I used the interbank rates was because it was more readily available to me. Third, what is monetary policy? Monetary policy is when the central bank uses interest rates and open market operations to manipulate the amount of money circulating in the economy. This in turn helps control inflation and unemployment. In economic theory, when the central bank increases interest rates, demand for loans by consumers and businesses decreases, which leads to fewer loans taken, which means that lending volume also decreases. But it's not always that simple. Some studies say that how much lending actually drops depends on how strong the banks are and what's happening in the rest of the economy. Other economic factors affecting lending include oil prices, government fiscal policy, inflation, business confidence, and consumer demand. Alright, moving on to the next slide, which is about the GCC context. UAE and Saudi Arabia's currency both are pegged to the US dollar. So that means $1 US is equal to 3.67 dirhams and $1 US is equal to 3.75 Saudi Arabia riyal. Because both the countries' currency are pegged to the US dollar, they have to closely follow United States' interest rate policies as well. So ideally, if the US increases their interest rate, UAE and Kingdom of Saudi Arabia will have to do the same. Okay, now we're going on to the methodology and data collection slide. So for this study, we're making a few key assumptions. First, when US interest rates go up, interest rates in the UAE and Saudi Arabia also go up. Second, when interest rates rise, borrowing becomes more expensive, so naturally we'd expect lending to decrease. And third, higher interest rates can make it harder for people and businesses to repay their loans, which increases the number of non-performing loans or NPLs. Now, in terms of what countries and what time frame we're focusing on, this study looks specifically at the UAE and Saudi Arabia, the two largest and most influential economies in the Gulf region. Both have strong modern banking systems, and they also publish reliable financial data, which makes them ideal for this kind of research. The time period we're looking at is from 2015 to 2025, which includes a few important phases. So this time frame captures certain type of interest rate environments rising, falling, and sharply rising again, which gives us a broad view of how UAE and Saudi Arabia react to US monetary policy. Okay, so now we're going to be looking at the data sources and key variables. So for this study, I used data from reliable and official sources. From the Central Bank of the UAE, I took their monthly and quarterly bulletins and financial stability reports. From Saudi Arabia, I used data from the Saudi Central Bank, also known as SAMA. They provide financial statistics and loan-related data. And to track non-performing loans, I used graphs and datasets from CEIC data, which is a global economic database. Now, in terms of what data I actually focused on, the key variables were interest rates, more specifically interbank rates like the US Federal Funds Rate, EBOR for the UAE, which is the Emirates Interbank Offered Rate, and SIBOR for Saudi Arabia. The second variable I looked at was domestic credit, which is basically the amount of loans or credit given out within each country, measured in dirhams for the UAE and riyals for Saudi Arabia. And finally, non-performing loans or NPLs, which are loans where the borrowers are not paying back on time or they fail to pay back the loan. As for the time frame, I collected monthly data for interbank rates from 2015 all the way to 2025. But for domestic credit, I only used the year-end values, meaning the values from each December from 2015 to 2025. Limitations. Now, just like any study, there are a few limitations to keep in mind. First, I didn't consider some other economic factors like inflation, GDP, new government regulations, or oil prices. And especially in the Gulf region, oil prices can have a huge impact on the economy and bank lending, so leaving that out is definitely something to note. Second, the analysis was done at a country level, meaning I looked at overall data for the UAE and Saudi Arabia rather than data from individual banks. Okay, so this is the chart for the 3 months interbank rate for UAE, USA and Saudi Arabia. As you can see, the interbank rates are all moving together. The blue line is USA, the red line is Saudi Arabia, and the green line is the UAE. So I'm just going to briefly describe what the overall trend was and what the interest rates were during that particular period of time. Okay, so from 2016 to 2018, the United States was recovering from the 2008 financial crisis. The economy was getting stronger, unemployment was falling, and the growth was picking up. So the US Federal Reserve began gradually increasing interest rates to avoid the economy from overheating and to keep inflation under control. So as you can see, from July 2015 till about July 2019, interest rates gradually rose to about 2.4%. Then came 2020 and COVID-19. When the pandemic hit, the US economy basically froze. Businesses shut down, people lost jobs, and the government needed to act fast to stop a deep recession. So the Federal Reserve slashed interest rates to near zero, almost 0%, to make borrowing cheaper and to help boost spending and investment. So UAE and Saudi Arabia, again, they did the same thing. When the pandemic hit, they had to cut interest rates to zero or close to 0%. But by 2022, the problem had flipped. Inflation had surged, prices were rising fast because of supply chain issues, high demand, and the war in Ukraine. So to cool things down, the Fed started aggressively raising interest rates again. In about a year, they went from near zero to above 5%, which is a really fast increase in interest rates. Okay, now this graph talks about the domestic credit trend in the UAE, which is basically the bank lending in the UAE. And this second graph looks at the percentage change in the domestic credit. Percentage change basically means how much lending increased or decreased compared to the previous year. So if domestic credit has stayed the same, the percentage change will be zero. If domestic credit has decreased, the percentage change will be negative. If the domestic credit has increased, then the percentage change will be positive. Okay, so going back to the UAE domestic credit graph, overall domestic credit in the UAE has been in an uptrend. In 2015 and 2016, credit grew strongly by 8.1% and 5.3%. This was when the US had just started raising interest rates in late 2015, and during this period, the economy was recovering from the 2008 financial crisis, so people and businesses started to feel confident enough to borrow. But in 2017, lending in the UAE slowed down and it almost stagnated. Right, you can see it slowed down and it stagnated, and that's why the percentage change is zero. Then in 2018 and 2019, lending picked up again and it increased 3.9% in 2018 and 5.6% in 2019. The economy was doing okay, but higher interest rates still kept borrowing somewhat limited. Then came 2020 and COVID-19. That year, credit growth in the UAE was basically flat. right? Even though interest rates were super low, businesses and households weren't eager to borrow. The issue wasn't borrowing costs, but mainly it was uncertainty. People just didn't know what would happen next, so they held back. Again, during this period, the percentage change again came close to 0% in December 2020, which was during the pandemic time. Then in 2021 and 2022, rates stayed low. So 2021 to 2022, rates stayed low. Credit only grew by around 1.4% and 2%. Mainly banks were careful and many borrowers were still nervous. The mood hadn't fully recovered yet and credit risk was still a concern. Then finally in 2023 and 2024, lending finally gained momentum. 5.3% growth in 2023 and 6.4% in 2024. What's interesting is that this happened even while US interest rates were rising fast to fight inflation. Right? 2023 and 2024, the US interest rate was relatively high at 5%, but lending still grew in the UAE. And so despite higher rates, lending increased. This tells us that the US economy was strong and confidence had returned. Now this is the domestic credit graph for Saudi Arabia. Again, a similar pattern was experienced with Saudi Arabia. The only exception was that in Saudi Arabia, after December 2022, domestic credit had decreased. So as a result, percentage change is negative, indicating a decrease in domestic credit. Also, one more thing to note would be that UAE and Saudi Arabia's domestic credit was around the same from 2014 to 2015. As you can see, Saudi Arabia's domestic credit was around 1500 billion riyals, and for UAE it was close to around 1300 billion dirhams. But over the years, Saudi Arabia's domestic credit grew much more significantly than the UAE. So Saudi Arabia went from close to 1500 billion riyals to just over 3000 billion riyals in December 2024. But UAE only reached around 1850 billion dirhams in terms of domestic credit. So overall, Saudi Arabia's domestic credit has grown more sharply compared to the UAE, which means they've basically given out more loans to people and businesses. Alright, so we're done with Saudi Arabia's domestic credit. Now moving on to the non-performing loans percentage for the UAE. So NPL ratio is the percentage of loans that were not paid back. So from 2014 to 2018, things were pretty stable. Right, the NPL ratio hovered between 4.5% and 5.5%. But things started to get worse between 2019 and early 2021. The NPL ratio had climbed up to around 8%, meaning more borrowers, both individuals and businesses, were having trouble paying back their loans. Again, this didn't have much to do with the interest rates, but rather because it was a period of economic uncertainty. And then finally, from 2021 to mid-2024, we saw a steady improvement. The NPL ratio dropped to around 4.8%, which was the pre-COVID range, right? Again, what's interesting is that during this period, the US had increased their interest rate. If you go back, interest rates were still relatively high, but the NPL ratio had sort of improved, and this might have been because of their economic recovery after COVID. Now again, a similar pattern can be observed here with Saudi Arabia, but there is one key difference between Saudi Arabia's and UAE's NPL ratio. Saudi Arabia currently has twice the domestic credit compared to the UAE, right? As I had mentioned earlier, twice the domestic credit compared to the UAE. But Saudi Arabia's NPL ratio has consistently remained below 2.5%. So Saudi Arabia has not only given out more loans, but their non-performing loans percentage has also remained lower than the UAE's. So why is this? First, Saudi Arabia has a stronger economic cushion. It earns more from oil and holds more foreign reserves, around $410 billion as of early 2025, compared to the UAE's $219 billion. So when things go wrong, Saudi Arabia has more money to support its economy and avoid widespread loan defaults. Second, Saudi banks are generally more conservative. Many of their loans are either Sharia compliant or asset backed, which makes them less risky by design. Plus, the Saudi Central Bank keeps a close eye on its banks. They enforce higher capital ratios, adopted Basel IV rules early on, and they made sure that banks don't take unnecessary risk. Okay, so the next slide is about correlation and regression analysis. So to understand how correlation and regression analysis between interest rates and domestic credit growth for the UAE. So to understand how interest rate changes affect bank lending in the UAE, I created a scatter plot comparing UAE interbank rates with domestic credit growth from 2015 to 2025. So the x-axis, which represents the independent variable, depicts the percentage change in the interbank rates, and the y-axis represents the domestic percentage change in domestic credit, which represents the dependent variable. So the trendline equation that came from the chart was y is equal to 0.321x plus 0.0267. So one thing that's surprising is that the value of the x, the value of the sign of the coefficient of x is positive. Now that means there's a slight positive relationship between interest rates and credit growth, meaning as interest rates go up, lending also increases. But that's a bit surprising because economic theory usually says the opposite. When borrowing becomes more expensive, people and businesses generally take fewer loans, not more. Secondly, the R squared value is 0.0357. So that means only about 3.6% of the changes in the credit growth are explained by interest rates in this model. So overall, this tells us that the connection between interest rates and lending in the UAE is extremely weak. Other factors like oil prices, government fiscal policies, or business confidence are probably having a much bigger influence in the UAE. And then I did the same thing for Saudi Arabia, but this time the trend line from the graph gave us the following equation: y is equal to minus 1.8815x plus 0.1363. And for Saudi Arabia, we got an R square value of 0.2367. So what does this tell us? So the equation shows a negative relationship because the coefficient of x is negative, right? Negative relationship. So which means that as interest rates in Saudi Arabia go up, credit growth tends to go down. And that makes sense because higher interest rate means borrowing becomes more expensive, so fewer businesses and people take out loans, which slows down overall lending. Now the R square value of 0.24 means that around 24% of the change in credit growth can be explained by changes in interest rates. That's not a very strong relationship, but it's definitely stronger than what we saw in the UAE, where interest rates barely explained any of the lending trends. So overall, this result suggests that US interest rate changes do have a noticeable effect on bank lending in Saudi Arabia. The data shows that monetary policy plays a more direct role in shaping credit conditions in Saudi Arabia, much more than the UAE. Other factors still matter, of course, but interest rates clearly influence how much businesses and people in Saudi are likely to borrow. And finally, the findings and conclusion. So to wrap things up, the study looked at how interest rate changes, mostly driven by US monetary policy, affect bank lending and credit risk in both the UAE and Saudi Arabia. I used data from 2015 to 2025, including interbank rates, domestic credit figures, and non-performing loan ratios. What I found is that Saudi Arabia consistently performed better than the UAE when it comes to loan quality. For example, Saudi Arabia's NPL ratio stayed below 2.5% even during the COVID-19 pandemic. This might be due to stricter lending standards and better risk controls in Saudi banks. And moving on to the next slide, which is limitations. I forgot to mention I only used year-end credit data and annual averages for interest rates, and so I might have missed some short-term trends. Secondly, my sample size was limited to around 10 to 11 years, so from 2015 to 2025, which is not ideal for long-term economic pattern analysis. I mentioned 11 years because for some of the data I took from 2014 to 2025, and then for some of the other data sets I took from 2015 to 2025. In short, while US interest rates do affect bank lending in both countries, Saudi Arabia seems to respond more directly. The UAE's lending patterns appear to be shaped more by other domestic and regional factors. Thank you.